Joining us now on set at Post 9 is Chris Maher. He's OceanFirst Financial Corporation Chairman and CEO. I should say, of course, it's a bank in our area here, in the New Jersey area as well. About $1.1 billion market cap. What have you been seeing from your customers, particularly as it relates, of course, to this, we hope, was short-term panic among some to get their deposits out of smaller banks?
That panic was really limited, and we didn't see any of it in our customer base. I have to tell you, I deal with a lot of my peers, as you'd imagine. I'm active. I chair the New Jersey Bankers Association, Mid-Sized Bank Coalition, ABA, ICBA. In the last 72 hours, I have yet to talk to a regional or community bank CEO that has had any significant flow of deposits. So I think we're moving through this. The system is in great shape. There's a lot of liquidity out there. We're feeling virtually no stress at all, which is terrific.
Obviously, a lot of this started in part, it's unique to SVB perhaps, although Signature, of course, also a casualty because of concerns about their securities portfolio.
That's right.
Not to mention loan portfolio to some extent, and the marks that are being taken or not taken. How about your assets? What do they look like?
Well, we couldn't be more happy with our balance sheet, right? So we're a very conservative bank, been around, 120 years. We have a strong tangible common equity position, and we have very few losses in our securities portfolio. So sitting on a pile of liquidity, you're doing all the things you would do in a crisis. So we feel really good. But
although duration does play a role here, doesn't it? And what your decisions are in terms of how you're using those deposits. How did you guys approach it, over the last couple of years?
Let me make a great point, David. So during the pandemic, a lot of banks, including the ones we talked about, got an inflow of deposits. We did as well. At one point, we had $1.3 billion just sitting at the Fed, just kind of wave of money that came in. It was critically important that you made prudent decisions on how to deploy that. We kept our securities portfolio short. We kept it small, and we favored investing in floating rate assets. I saw a chart the other day that said that the interest rates were at a 5,000-year low. So you stop and think about extending duration in that environment is inexplicable to me. I'm not sure why people did that.
Well, I think we know why they do it, right? I mean, it was EPS. They were reaching for pennies.
Oh, absolutely, yeah. Carl. And we saw during the pandemic, our margins decreased a little bit, right? There's pain with that. You have to talk to your investors, make sure they understand why. But our margins increased every quarter last year. We set the balance sheet up for this, and I think there's a lot of banks that did that. We're Main Street banks, not Wall Street banks, and we invest in customers. We have only 403 customers that have more than $1 million of uninsured at-risk deposits in our bank. That's out of 250,000 customers.
So do you not hear from customers who say, why am I with you when I could be over here getting 4.5?
Yeah, that's great, Carl. We do hear from customers, obviously, the last couple of days, if they're watching the news and they're concerned. It's an easy hand-holding conversation. I'll tell you this, they recall what we did for them in PPP. They remember we were there for them in the financial crisis, the dot-com, in our case, Hurricane Sandy. Community banks and regional banks are there for their clients. We were the ones that were quickest to get them support during the pandemic. They appreciate that, and we've got a lot of support from them.
Yeah, I mean, a lot of political support in the past for small and mid-sized banks as well, for the reasons that you just stated, important for our economy. And yet, one of the upshots of this is going to be tougher regulation, right? Higher cost of capital, and ultimately lower earnings. And perhaps that's one of the big reasons for the slide in shares. What do you expect on that front?
Well, look, anytime you have an event like this, you're going to stop and pause. And you're right, Sarah, there could be more regulatory focus. But I have to tell you, these liquidity plans are something that has been around, since the dawn of the banking industry. If you weren't good at managing your liquidity, your regulators were already, in many cases, on top of that. So I don't deal with the state of California or the state of New York in terms of their regulators, but I can tell you ours, which are the Federal Reserve and the OCC, have been focused on this, not just today or last week. They've always been focused.
Chris, are you concerned at all at the nature of the current version of a bank run? Namely, it occurs on this, whether it's people looking at Twitter and saying, oh, my God, they're lining up at this bank, and then saying, well, why take the chance? Does that change sort of the way you would respond to any crisis?
Sure. I mean, the velocity of money is just fundamentally different than it was just a few years ago. So I think it's incumbent on us to be able to react quickly, to put information in customers' hands, to get ahead of rumors, to get in front of our customers, but to recognize that there is this ability to move money quickly.